Welcome. Today we will break down Bigbear AI. Is it the next Palantir? Both companies are making headlines in the AI and data analytics world, particularly in defense and government contracting. Let's break down the facts, compare the two, weigh the pros and cons of BBAI, explore its growth potential, and decide if it's worth buying right now. Grab a coffee and let's get started. First, let's talk about what these companies do. Palantir Technologies, founded in 2003, is a heavyweight in AI-driven data analytics. Its platforms, Gotham for government clients and Foundry for commercial customers, pull together massive data sets to deliver actionable insights. Think counterterrorism, fraud detection, or optimizing supply chains for big corporations like Morgan Stanley. In 2024, Palantir generated $2.8 billion in revenue, with 37% from commercial clients and 63% from government contracts. Its revenue grew 39% year over year in Q1 2025, and it's consistently profitable, with a net income of $467.9 million last year and adjusted earnings per share up 62% to 0.13 in the latest quarter. Palantir's market cap is a staggering $253.5 billion, and it's trading at a forward price-to-sales ratio of 75.6 times 2025 estimates. Bigbear AI, on the other hand, is much smaller, with a market cap of about $1.4 billion. Formed in 2021 through a SPAC merger, it focuses on AI-powered analytics, predictive modeling, and computer vision, primarily for defense and national security. Its clients include the Department of Defense, NSA, and FAA, with recent contracts like a $165 million 5-year deal with the U.S. Army for geopolitical risk analysis. Bigbear's revenue in 2024 was $165 million, up 22% in Q3, but it's not profitable, posting a net loss of $257.1 million last year, partly due to derivative valuation changes. It trades at a forward price-to-sales ratio of 7.2 times 2025 estimates, making it look like a bargain compared to Palantir. Now, let's compare their business models. Palantir's strength lies in its diversified revenue streams. While government contracts still dominate at 42% of revenue, its commercial segment is growing fast, up 29% in 2024. Its artificial intelligence platform, or AIP, is a hit, helping clients integrate AI into operations, from electric grid monitoring to military management. Palantir's 80% gross margin reflects its scalable software model, and its balance sheet is rock solid, with $6.3 billion in assets and $2.1 billion in cash against $1.2 billion in liabilities. Bigbear, by contrast, is more of a government contractor. It relies heavily on a few key clients. Four accounted for 51% of its Q3 2024 revenue, which introduces risk. Its business requires on-premises work for many projects, driving up costs and resulting in a lower gross margin of 25.9%. Bigbear's balance sheet is concerning, with liabilities of $346.4 million, slightly exceeding assets of $343.8 million at the end of 2024, though it reduced net debt from $150 million to $27 million by March 2025 under new CEO Kevin McAleenan. Let's dive into the pros of investing in Bigbear AI. First, its valuation is cheap compared to Palantir, 7.2 times forward sales versus Palantir's 75.6. If you're looking for a high-risk, high-reward play, this is it. Bigbear is gaining traction with government contracts, like the Army deal, and a subcontract on a $2.4 billion FAA project. Its acquisition of Pangiam, a leader in facial recognition, opens doors in security and commercial markets like healthcare and warehousing, where it's working with Amazon. With a $437 million contract backlog, there's potential for revenue growth. Analysts predict 12% revenue growth in 2025, and if federal AI spending ramps up, potentially hitting $500 billion, Bigbear could benefit. Plus, its partnership with Palantir, integrating its AI modules into Foundry, could drive synergies. But there are cons. Bigbear's financials are shaky. It's unprofitable, with inconsistent revenue growth, only 5% in the latest quarter compared to Palantir's 39%. Its customer concentration and reliance on government contracts make it vulnerable to procurement delays, as seen in Q1 2025 when delays hurt its bottom line. The company's history of missing sales targets. Last quarter, it posted $41.5 million against expectations of $46 million, doesn't inspire confidence. Plus, with a Zacks rank of 4, sell, analysts are pessimistic about its near-term outlook. High short interest at 22.6% also signals skepticism, and insider sales of $93 million in the last 3 months suggest executives may not see immediate upside. What about future growth? Palantir's trajectory looks good. It expects 36% revenue growth in 2025, and its inclusion in the S&P 500 and NASDAQ 100 cements its blue-chip status. Its commercial expansion and AI platform adoption make it a safer bet for long-term growth, though its valuation at 536 times trailing earnings is eye-watering. Bigbear, while riskier, has breakout potential. If it can replicate even a fraction of Palantir's success, its low valuation could lead to massive returns. Posts on X are buzzing, with some calling it a 10x in the making or predicting a $100 stock price by 2027. Its focus on niche areas like biometrics and edge analytics could carve out a unique space, especially if geopolitical tensions boost defense spending. However, its smaller scale and financial instability make this a speculative play. You might be asking, so Diana, is Bigbear worth buying right now? Palantir is the stronger investment based on fundamentals, consistent profitability, diversified revenue, and a proven track record. But its sky-high valuation means you're paying a premium, and any market pullback could hit it hard. Bigbear offers more upside potential due to its low price-to-sales ratio and growing government contracts, but it's a high-risk bet. Its unprofitability, customer concentration, and inconsistent performance scream caution. If you're a risk-tolerant investor with a long-term horizon, a small position in BBAI could make sense, especially if you believe in its defense-focused AI niche. But for most investors, waiting for improved execution and revenue growth is smarter. In summary, Bigbear AI isn't the next Palantir yet. Palantir's scale, profitability, and market position make it the clear leader, but Bigbear's low valuation and niche focus make it an intriguing underdog. If you're considering BBAI, only risk what you're willing to lose, diversify, and stay ready for volatility. What do you think? Would you bet on Bigbear or stick with Palantir? I own both. Drop your thought in the comments, subscribe for more deep dives into stocks. Thanks for watching, and I'll see you next time.